The date was October 28, 2024. While Premier Doug Ford was fielding questions about trade talks with the United States, his office received an urgent briefing that would change everything. Surrey, British Columbia's housing market had just posted numbers that sent shockwaves across Canadian real estate circles. Home prices in Canada's fastest-growing city had dropped over 15% in 6 consecutive months, with inventory levels reaching a 10-year high. But this wasn't just another regional correction. What happened next would expose the interconnected web of Canada's housing crisis and reveal why a market collapse 3,000 kilometers away could trigger panic at Queen's Park. The numbers were staggering, the implications immediate, and the political fallout inevitable. Within hours of Surrey's market data release, Ford's housing minister Rob Flack was on emergency calls with federal counterparts. Why? Because Surrey's collapse represented everything Ford had been desperately trying to prevent in Ontario. The city that had symbolized Canada's housing boom was now becoming ground zero for its potential bust. This isn't just about one market or one province. This is about a crisis that has been building for years, finally reaching its breaking point in the most unexpected place, with consequences that will reshape Canadian housing policy forever. Surrey's housing market didn't collapse overnight. It was the culmination of 6 interconnected forces that had been building pressure for months. Understanding these factors reveals why Ford's reaction was so intense and why this collapse matters far beyond British Columbia's borders. Surrey ended 2024 with over 35,000 new listings, representing a 10-year high and a 9% increase from the previous year. But raw numbers only tell part of the story. The Fraser Valley Real Estate Board reported something unprecedented. Homes were sitting on the market for an average of 45 days, compared to just 12 days in 2022's peak market. What changed? Interest rate sensitivity finally caught up with buyers who had stretched their finances during the pandemic boom. Families who qualified for mortgages at 2% suddenly found themselves unable to afford payments at 5.5%. The human impact was immediate. Sarah Chen, a Surrey resident, watched her townhouse lose over $200,000 in value while still owing $450,000 on her mortgage. This inventory explosion became the first visible crack in what many considered an invincible market. While inventory soared, new construction ground to a halt. Housing starts in the Fraser Valley dropped 24% in 2024, with developers citing financing costs and regulatory delays as primary barriers. The irony was stark. Surrey desperately needed new housing to meet population growth, yet the economic conditions made building financially impossible for most developers. Permit applications fell 30% as projects became economically unviable. Construction employment in Surrey dropped by over 3,000 jobs, creating a ripple effect through the local economy. Workers who had moved to Surrey for construction opportunities found themselves unemployed in an increasingly expensive city. This construction freeze created a paradox that would later influence Ford's own housing strategy. How do you build affordable housing when the economics of construction make affordable development impossible? The Bank of Canada's interest rate cycle hit Surrey harder than almost any other Canadian market. The city's median home price of $920,000 meant that even a modest rate increase translated to hundreds of dollars in additional monthly payments. Mortgage stress tests that seemed manageable at 3% became insurmountable at 5.5%. Real estate agents reported that 50% of potential buyers who qualified for pre-approvals in early 2024 could no longer afford the same properties by October. The psychological impact was equally devastating. Buyers who had been conditioned to expect constant price increases suddenly faced a market where waiting meant better deals, not missed opportunities. This fundamental shift in buyer psychology accelerated the market's downward spiral and created the conditions that would later alarm Ford about similar risks in Ontario. Surrey had become a magnet for real estate investors during the pandemic, with investment purchases accounting for nearly 30% of all transactions in 2022. But as prices began declining and rental yields compressed, These investors became sellers. Unlike homeowners who might hold through a downturn, investors calculated returns and exited systematically. Property management companies reported investor clients listing multiple properties simultaneously, flooding the market with similar units in the same neighborhoods. This created localized price wars that drove values down faster than natural market forces alone. The exodus was particularly pronounced in Surrey's condo market, where investor-focused units sat unsold as developers struggled to attract end users. These weren't homes designed for families, they were financial products optimized for price per square foot, and when the financial calculus changed, they became stranded assets. British Columbia's housing policies, designed to cool the market, worked too well in Surrey. The empty homes tax, foreign buyer taxes, and speculation taxes combined to create a perfect storm of selling pressure. Owners who had been holding properties suddenly faced annual carrying costs that made selling more attractive than holding. Municipal policies designed to increase density paradoxically reduced certainty, as developers waited for clearer rules rather than proceeding with existing plans. The provincial government's rent control measures, intended to protect tenants, discouraged investment in purpose-built rental housing, reducing the supply of rental options and forcing more people into the ownership market just as it was becoming unaffordable. This policy cascade created unintended consequences that multiplied the market's natural correction, turning what might have been a gradual adjustment into a sharp decline that caught policymakers off guard. The final factor was psychological. Surrey's market collapse became a self-fulfilling prophecy as media coverage amplified negative sentiment. Buyers postponed purchases expecting further declines, while sellers rushed to list before prices fell further. Real estate agents reported that clients were making decisions based on fear rather than fundamentals. Local businesses dependent on real estate activity began laying off staff, creating visible signs of economic distress that reinforced negative perceptions. Bank of Canada surveys showed consumer confidence in Surrey's housing market fell to levels not seen since the 2008 financial crisis. This confidence crisis was what ultimately triggered Ford's alarm, because confidence contagion spreads faster than economic fundamentals, and Ontario's market psychology was already fragile after years of affordability concerns. The Ford response, panic or preparation? When Ford received the Surrey briefing, his reaction revealed the depth of Ontario's own housing vulnerabilities. Within 48 hours, his government announced emergency measures that had been in development for months, but were suddenly fast-tracked. The decision to remove provincial HST for first-time home buyers wasn't a response to Surrey's collapse, but Surrey's collapse made the announcement urgent. Ford understood that confidence crises spread through social media and family networks that cross provincial boundaries. A generation of potential home buyers was watching Surrey's market and questioning whether homeownership was achievable anywhere in Canada. His government's housing target of 1.5 million homes by 2031 suddenly seemed both more critical and more impossible. Ontario had managed only 94,000 housing starts in 2024, far short of the 125,000 needed to stay on track. Ford's team analyzed Surrey's collapse for lessons applicable to Ontario. They found uncomfortable parallels: similar investor concentrations in key markets, comparable interest rate sensitivity among buyers, and identical policy challenges around density and development approvals. The Premier's public statements became noticeably more urgent about housing supply because Surrey had provided a preview of what market correction looked like in real time. Ford realized that Ontario's housing market wasn't immune to the same forces, and that preventing a Surrey-style collapse required immediate action rather than gradual policy evolution. The ripple effects across Canada. Surrey's market collapse sent shockwaves through Canadian housing policy circles because it challenged fundamental assumptions about market resilience. If Surrey, with its population growth and economic momentum, could experience such rapid price declines, every Canadian market was potentially vulnerable. The Canada Mortgage and Housing Corporation quietly updated their risk assessments for major urban centres, acknowledging that their models had underestimated the speed at which sentiment could shift. Ford's reaction was echoed by premiers across the country as they grappled with the realization that housing markets could correct faster than policy responses could adapt. The federal government found itself caught between competing pressures, homeowners demanding protection for their equity and potential buyers hoping for affordability improvements. Surrey's collapse provided both groups with evidence for their positions, creating a political challenge that extended far beyond British Columbia. Municipal governments that had relied on development charges and property tax revenue from continuous price growth suddenly faced budget shortfalls as transaction volumes collapsed. The interconnected nature of Canada's housing markets meant that Surrey's problems quickly became national concerns, explaining why Ford's response was so swift and decisive. Looking ahead, signals to watch. Surrey's collapse offers a roadmap for understanding housing market vulnerability across Canada. The key indicators that preceded Surrey's downturn are now visible in other markets: inventory accumulation, construction slowdowns, investor retreat, and confidence erosion. Ford's government is monitoring these signals in Toronto, Ottawa, and Hamilton because early intervention is more effective than crisis response. The challenge is distinguishing between healthy market corrections and potential collapses because the policy responses are dramatically different. The next 12 months will reveal whether Surrey's experience was an isolated correction or the beginning of a broader market reset. Ford's housing policies will be tested against this reality, as will his government's ability to maintain confidence while addressing affordability. The Premier's reaction to Surrey wasn't just about one city's market. It was about recognizing that Canada's housing system has become so interconnected that regional problems quickly become national crises. If you found this analysis helpful, make sure to like this video and subscribe for more in-depth coverage of Canada's housing market developments. Turn on notifications so you don't miss our upcoming analysis of how other provincial governments are responding to these market shifts. Let us know in the comments what housing market trends you're seeing in your area. This content represents analysis based on publicly available information as of October 2024 and should not be considered financial or investment advice.